possibly can at 9 o'clock. And so let's get going. Today's agenda, we're going to go, of course, through our introductions. And then obviously we're going to talk to you about our ecosystem. We're going to tell you all the great things that are happening and encourage you to join each and every single one of our Zooms. They're all value packed, I'm telling you. And then, of course, we're going to go into our main topic. Will Otis, the man, is going to break down going in cap rates for you guys. And hopefully, we'll be able to serve you a little bit of value there with that. And then, of course, we're going to get into our deal. We're going to check it out. And if anybody has other deals and we're able to get to it, we'd love to see it. So with that said, who are we? Well, Ed, I'm gonna leave it to you to introduce yourself. A man who needs no introduction, really, but it would be a disservice if I introduced you.
So thank you. What's up, everyone? Again, Ed Shamirian, based out of Los Angeles, California. Licensed agent here in Cali. Love underwriting, love talking to brokers and breaking the numbers down, and love bringing value to you guys and everyone else in the community as much as I can. Please let me know how I can help you guys, and always feel free to reach out. My number is under the name. And yes, I am logged into Marcel's account, which is why you see his photo by my name in the participation and in the chat. That confused some people last time, but again, please reach out for anything. Always here to help out, and you guys take it away.
Awesome. Thanks, Ed. Well, I'm Aldo and Cheta, my partner, my ride or die since the last decade or so. It's been, 15 years. So we are with Stoic Holding Solutions. We're currently, our W2 is in the senior living space. Will Otis is the vice president of operations for our company, and I am the director of asset management. So with our powers combined, we know a little bit about operating and a little bit about underwriting and asset management, etc. And so with that, we hope to bring you a little bit of value. And if you have any questions around that space, feel free to reach out to us as well. We'll put out our contact information here in a little bit. But enough about us. Let's hear about you. I'd like somebody to come on, jump on here, introduce themselves, or I'm gonna volunteer somebody. And you can unmute yourselves if you want.
Jerry, raise your hand.
All right, somebody raise their hand. Jerry, man, what's up? Our very own Jerry Miles, folks.
How's it going, guys?
Yeah, it's going, man.
What's up, buddy?
Yeah, I've been missing a lot of calls lately, so I said, man,
good. You were
I'm
hanging out
actually
with Grant Cardone, so we'll
able to jump on one. So it's good to see you guys.
You too, man.
Likewise.
Yeah, for anybody that doesn't know me, I'm Jerry Miles. I'm a commercial mortgage broker. We lend on commercial real estate, everything from a fix and flip to your biggest apartment or development deal. We've got lenders for every amount, from 100,000 on up. So,
I love it.
Good to see everybody on here.
Introduce yourself.
Thanks, Jerry. Appreciate you jumping on, man. And just so everybody knows, Jerry is the official lender for the multifamily freedom chasers. So if you have any questions around the debt space, he is your man. And matter of fact, we'll be talking about part of the ecosystem that he's part of as well. I'm gonna take one more, and just person jumped out at me, David Retniller. I'm gonna call you out, man. What's going on? Tell us about you.
How's it going? Well, yeah, you beat me to it. I was about to hop on after Jerry, but
Nice.
I guess we're thinking on the same page. So yeah, I'm David. I live in Atlanta, Georgia.
All right.
Just graduated from, I'm sorry.
I said, all right, man.
Oh, okay. So I graduated from college last May, and
Congrats.
I was getting started in just learning everything I can right now about multifamily investing. And I hear, Jerry, were you at Grant's Summit this past weekend?
Not at this week, not this past one. No, I've
Oh,
been at the
okay.
last 3 of them previously, but not
Oh,
this.
okay. I just missed you then because I that was my first summit and it was awesome.
Awesome.
So yeah, that was really cool. And then so yeah, my W-2, I'm a software engineer. So maybe that'll help in real estate, we'll see. But then yeah, in terms of just where I'm at with investing, so I'm part of the multifamily mindset network. I joined that network and like mentorship programs, so I'm just going through that and like I said, just learning as much as possible and you know, looking to do my first deal as soon as I can.
Awesome, man. Well, hey, we're glad to have you here and we're glad you spoke up. It's
Real quick, let me help with that a little bit. If you can, everyone put in your name, how to reach you, and what you're looking for, what your superpower is, all the things that we usually ask for, just so people get to know you better. I would love for everyone here to volunteer and say who they are, but we want to do about 1 or 2 every week. So just network in the chat as well. That's what it's there for. We could very easily close it, but that doesn't benefit anyone, so interact in there. Let us know where you're looking to buy. Let us know what you guys are good at and what your superpower is. And it'll really help with connecting.
absolutely, absolutely. Well, thanks, guys. Thanks for introducing yourselves, and we're gonna go ahead and move on to the ecosystem. So go ahead, Ed.
Yeah, what's up, everyone? You guys know we have the Sunday activation Zoom. This past one was an awesome one. It was a little bit different in regards to being more of the legal side of things, which is you don't want to get burned by, especially your first deal. So check those out every Sunday, 8:30 Eastern, and then we follow up with a awesome call with Peter with calling live brokers and reviewing calls and just going over the strategies of how to really get those off-market deals and build a relationship with the broker and have someone on your team. You're building a team at the end of the day, not only amongst the community and amongst yourselves, but with the army that you eventually can go to war with when taking these properties down. So I help Peter with these calls, and then of course you have ours on Tuesday, which you're here. Every Tuesday, 8 p.m. Eastern, you know where to find us. And then of course, Wednesdays, we have an alternating schedule with either the financing or the advanced underwriting. Please note there is a time difference, so make sure you know what week is whose turn and what time their call starts. We want to make sure we get all you guys there. If you do miss a call for whatever reason on any of these, we do have a YouTube page that does have the replays, so please feel free to check that out. Multifamily Freedom Chasers YouTube. And then of course, anytime you watch a replay or you see something or we don't have time for questions in the moment, reach out to us. We're all very responsive. We have group chats and we try to be available to you all. I speak for everyone here that we do this and give our time so that we can help you guys. So let us know on that end as well. And we can hop into the cap rate discussion that we wanted to have. It's actually a great call for Jerry to introduce himself because a lot of what we're talking about has to relate, and I'll let Will kind of go over what that is. I appreciate that, Jennifer. Thank you.
Good deal. Well, so guys, this is our contact information as Ed and Aldo talked about. We are always available. So if you guys have any questions, screenshot this, take out your phone, put down our email addresses. We're always here to help support you guys. And we'd love to hear from you. Also, we've been getting a few emails of people sending us deals for us to be able to evaluate prior to the call, and it's super helpful for us to be able to take a look at the deal before we hop on here. So if you guys have deals that you want to send to us, please feel free, email us. We'd be happy to take a look at it and then talk about it on this Zoom. So with that, we're going to get into kind of our topic for the night. If you've been joining us the last several weeks, we have been just kind of doing some very entry-level discussions and topics on, first of all, what is napkin underwriting? Why is it important? We talked about that a couple weeks ago. Last week, we talked about all of the tools that you need to effectively napkin underwrite, which is your rent roll, the rent rolls on the property, your T12 on the property. And so this week, what we want to talk about a little bit more is the going in cap rate. So who is brave enough to tell me what they think the going in cap rate is? It pretty much is exactly what it is called. So feel free to either throw it in the chat or speak up, take yourself off mute. Who wants to venture and tell me what the going in cap rate is? All right, I don't think anyone wants to speak up. So the going in cap rate, guys, is simply the cap rate that you are purchasing the property at. Okay, so it's really that simple. And the way that you calculate cap rate, and I know cap rates can get really confusing. And so today we want to try and demystify it a little bit for you and try and make it a little bit easier. But simply, again, that going in cap rate is really simply the cap rate that you are purchasing the property at. And exactly right. The way you calculate your cap rate is you take your NOI and you divide it by the purchase price of the property, which will give you your going in cap rate. So why is the going in cap rate important? And also, how does that relate to the debt market? And we're just going to give you a very, very high level, some discussion points here. And Ed and Aldo, please feel free to jump in whenever you'd like. But essentially, the reason why it's important is because the going in cap rate really helps you as the investor decide and really determine whether a particular property is a good investment. Now, when Aldo and I are evaluating deals, typically what we like to see personally is about a 1% spread between what we can get in the debt market and what we are purchasing that property. Now, that's just a rough rule of thumb. So for instance, if we can get debt on a property at 5.5% or 5.75%, our hopes are that we can purchase the property at closer to like a 6.5 to 6.75% cap rate. Now, that is not always possible. And if you've been seeking, looking for deals here recently, you may notice, and I know we have for sure, that typically most brokers and sellers right now, they are typically trying to sell their properties. It depends on the market, of course, but Aldo and I, we're in the Southeast. We're based out of Chattanooga, Tennessee, and what we're typically seeing here in the Southeast in kind of a 2 to 3 hour radius around Chattanooga is most people are selling properties for around a 5.5% cap rate. Now, that may be completely different for your market, but that's about what most properties are being listed at. We are starting to see those creep up a little bit. And as you see the cap rates creep up, what that means for you as an investor is that you can typically get into that property at a lower purchase price, which is, in my opinion, good for us as an investor. Now, if an entry cap rate is higher, then so when looking at entry cap rates, what you want to determine is that entry cap rate higher than the rate of return that you need to receive on the investment. So what I mean by that is if you see that the entry cap rate is, let's just go out on a whim here and say it's a 7.5% return or 7.5 cap rate, which if you find one of those deals, we would love to see
Jump
that.
on it.
Okay. But let's just say that it's a 7.5. But in reality, you need maybe a 6.5% deal or 6.5% cap rate for this deal to work for you, for your investment. That would be considered a good investment. Now, obviously, if it was reverse of that, and if the going in cap rate, it was lower than the rate that you really needed for this deal to make sense, obviously it would not be a good investment for you to probably worth wasting your time pursuing. Now, the going in cap rate is really helpful. And as I mentioned earlier, it is very specific to the market. Okay. And so your going in cap rate can also be really helpful when comparing different assets. So let's say, for instance, you're looking at 2 or 3 different assets. As an investor, the going in cap rate can be a really good metric for you to kind of evaluate, hey, is this a good deal for me to pursue or not? And so, you know, as I mentioned earlier, Aldo and I, we typically look for at least a 0.5% spread above what we're going to be able to get debt for on the property. So, you know, but if we can get it closer to a 1% spread, then, you know, that's typically what we look for. Now, what happens if you, let's say, for instance, you're looking at a property and it's a 3.5% cap rate, but you are able to get debt on the property at 5.75% or 6% or whatever the current debt market is determining at this point. That would be called a negative leveraged property. So what does negative leverage mean? That means that the debt that you have on that property costs more than the cash flow you are receiving. Okay. So what that means for you, and the result of that, is that that's going to decrease your annualized yields. That's going to decrease your ability to cash flow the property. And, you know, for myself, for Aldo, I'm sure many of you here on the call, that's super important to us, is to ensure that we cash flow on our property. That is something that we always look for when we're trying to evaluate deals is, you know, does this property cash flow? Now, that doesn't necessarily mean that negative leverage is a bad thing. With that being said, you just have to be very careful going into a deal when you are negatively leveraged. And again, it is very much so market specific. So again, you know, to kind of sum it up quickly, the going in cap rate is essentially that. It's the cap rate of what you're purchasing the property at. And as it relates to the debt market, you know, typically, you know, we like to see a nice spread or between what you can get debt on the property and what you're purchasing that property at, and like to see a cap rate that's, you know, close to 1% higher than the debt that you can get for that property. So Ed and Aldo, feel free to chime in on that.
I got something to say real quick, and thank you for that. Will, definitely, I think that was a great explanation for the cap rate. That's a good point someone made in the chat as well, based on the class. Yeah, that's true. That class is definitely a component of it, but a few things I want to add. And Jerry, why I mentioned it's so good having Jerry on the call, because you want to have this connection like Jerry. Why their family does the call every other week is, if you don't know what your debt cost you, you don't know what you're comparing the cap rate to. Like, you could get in at a 7 cap, but if your rate's 8% and you think it's 5, well, your numbers are off, right? So that's what's important, and I'm sure Jerry can explain this more, but the rate's changing right now almost every week, it feels like, if not every day sometimes. So that's important to know what your actual cost is on your capital, which is very important. And why I say cost of capital, because it's not only your loan, but it could be your seller finance, which is every deal I'm offering on has a component of. So I don't want to get too far into that. That's more of a, that's past the napkin underwriting. So we'll get into that maybe another week, but just know that the cap rate is important, and your debt rate is important, but there are other components as well. Here's one trick that brokers may try to do as well when it comes to the cap rate and how it's going to reflect on the deal, is how do you offset a low cap rate is with a high down payment. Be careful of that. You don't want to just, oh, the cap rate or the OM looks great based on the pro forma. Well, yeah, because they're telling you to put 55% down. If I put 55% down, it better look good, right? So those are little tips and tricks to look for when you're underwriting a deal. Another thing that was mentioned that's a very good point is know your market. That's a big one. Also, you want to obviously it's what is the cap rate based on? We mentioned NOI by price, but it's also expenses and income. Why is the cap rate what it is? How can I improve on that number? And if they had a high expense bill for XYZ, if they have low income for XYZ, the only thing you can really change is the price. You can't change the numbers of how they're operating, but you need to know why. Because at the end of the day, that's where the value add comes in. So that's just a few things I wanted to touch base on regarding the cap rate. So if you guys have any questions, please leave it in the chat. And if anyone has anything else to add, please leave a message as well.
So yeah, a couple of things just to piggyback off of what both of you have said. And just to be clear with everyone, we're talking about going in cap rate. We're not talking about the market cap rate. We're not talking about what, CoStar says the cap rate is, or what brokers think the cap rate is, or sellers think the cap rate is. This is the actual cap rate going into the deal at the current price, at the current performance, based on those two things. And like Ed shared, this is going to be based on the things that we've talked about before. Your rent roll, what are your average rents? What is a typical expense ratio for this asset class? And then what's the NOI on that, right? You can also, and we can get into this later on, but you can also determine a going in cap rate based on the T12s, and you can play around with that. There's different ways that they present the data. I don't know if you guys have seen an OM. There's like 20 different ways they break down the P&Ls. One of them is like T12 income and T12 expenses, T12 income and T6 expenses, or T1, annualized in so many different ways. And that changes the numbers. It varies it a lot. So you have to kind of start educating yourself around that. And so we might do a little bit more in that space later on. But again, we're talking about going in cap rate, and you compare that going in cap rate based on the current performance of this asset against what the debt you're able to get on this to avoid being negatively leveraged. Yes, Jerry.
Yeah, and something else to kind of keep an eye out for. They'll be broke down on the OM, but you kind of want to look at the actual T12 and really break it down from there. And then as you're looking at the T12, kind of look at like where it's going through the months. Like it might be from January to January, and you might notice that over the last 4 months it's lower. The income or the monthly NOI is lower than it was the previous 6 months. And kind of look out for those things, because when a lender grabs it, that's one of the first things they're going to start asking you about is, hey, why is the income down over the last 3 months? Or they're going to notice that it's going up, and your NOI that you figured, we might be able to get you better NOI because we can go off a T3 instead of a T12. And so there's a lot of different ways to look at it. And you kind of want to look at the whole T12 monthly as you're, kind of break it down that way.
That's excellent feedback, man. Yeah, absolutely. And, to your point, we had looked at several different deals, and the T12s were horrible, but the T3s were doing a lot better. And, the lenders were looking at that and giving us a little bit better of a rate on that, which really helps against your going in cap rate.
Yeah.
Appreciate it.
Yeah.
All right. Any other questions around this? So Jaden, I believe, had put something on here. Yeah, cap rate dictated by the class of the property, et cetera. Class A, yes, absolutely. So that is going to vary. Definitely agree with you on that. I would also say that it's important to keep an eye out on whatever asset class it may be, to be careful about being negatively leveraged, right? Because right now, class A, or back in the day, class A properties were, in the 4s or maybe even below 4. And that's because, the 10-year yield of the bonds were, low, and they could afford to be able to loan you something at that low of a rate. You're seeing assumable loans in that range right now from people that got good debt back a year or so ago. That's where they were able to capture them at such a low cap rate. but those are starting to go up, and we're seeing people coming off of their initial pricing. As I don't know if you guys are signed up to all those services, you'll see price reduction here, price reduction there. We've gotten several different ones, and so that's because people are underwriting at a lower cap rate than they really need to be based on the debt market.
And something else to keep in mind, I want to add, that's why you'll see properties with assumable loans sell for more than the property may technically be worth on paper, which you got to be careful with that as well when you're underwriting anything with assumable loans for two reasons. One is that you're probably overpaying on paper for the property, or they're asking you to overpay, I should say. And then also the other thing is you're probably gonna have to come with more down payment. And like I said earlier, an easy way to offset a low cap rate is just buy higher down payment, because that means you're carrying less debt, which means that your interest rate on your debt is gonna have less of an impact on your overall underwriting. So that's something else to keep in mind when you do see anything with an assumable loan. And that's personally why I always, again, going back to it, when it comes to an assumable loan, I always ask, are they willing to sell or carry some of the difference? Because it's usually going to be 45 to 55, maybe 60% leveraged, which means you have to come up with 40 to 55%. That's a lot for any property, right? So just be careful of that. And these are all things that we're not expecting. Like, I understand, like, we've opened a lot of different avenues where there could be questions, but these are all things that we'll eventually get into and cover. So I hope I didn't confuse anyone, but if you do have any question about anything specific, reach out. We'd love to help you guys more. But we'll eventually cover all these topics too.
That's right. You mentioned something, it just went off of my mind, and this is something that Jaden also commented on, which is, the relation of all of this that we're talking about, the cap rate, the debt, and then also the DSCR. These are all levers that are affected by each other. If one goes up, the other goes down, etc. And so it's really important to start to get to know each one of those and how they work independently, but then also how they work in conjunction or are affected by or affect the different levers that are on your valuation tools. So
good deal. Well, thank you guys. Appreciate you all jumping in there, and appreciate all the questions on this. So with that, what we'd like to do now is hear about your deals. And I know Jennifer, who's on here tonight, I see you have your camera on too. Jennifer actually sent us a deal earlier, sent it over to Ed. So I think we're going to take a look at that one first. And if we have time, if someone else has a deal that you'd like to have us throw in the calculator, then we'll do that if we have some time. So with that, I guess, yeah, Aldo or Ed, you guys want to take over from here?
Yeah, we have the screen share on with the calculator. I did forward you guys the email as well. So we can go over that and then have this calculator filled out.
Yeah, let's go for it, man. If you have this data, that'd be great. Do you happen to know what the average rents are here?
And is Jennifer, I think Jennifer's on the call.
Yeah.
Yeah, Jennifer, unmute yourself. We'd love to talk to you about it. Actually, I think she jumped off and is coming back on.
Looks like she just jumped off.
Jennifer, are you on? We're about to talk about your deal.
I'm
Awesome.
here. Sorry. Husband called. I had to answer.
All good.
Sorry.
All
Well, that's
good.
more important.
That's right.
Yeah.
That's right. Hey, so we're getting ready to go over this deal that you sent
Awesome.
over. Thanks for doing that.
Yep.
And so if you know the numbers off the top of your head, great. If not, I think we have the reference here. We're going to go over the average rents. Do we know what those are?
Okay. I sent over in the email what it looks like they're gonna, I guess I don't really know. I'm sorry. I don't.
No, you're good.
We have the
We have it.
Yeah, we have the rent roll.
The rent rules for 9 of
Yeah.
the 10 units, I believe.
Right. Only one of them's vacant right now. I do know
Okay.
that.
I do have other questions about the rent roll, but we'll get to that after. I'm not gonna
Okay.
get to myself yet.
So do we need to we can use this right here to
Here.
calculate current in place rate. So it's 10 units,
Yep.
Yes, 1 vacant.
1 vacant. And so what are we renting these at?
I can just go down the list if you want to go one by one.
Yeah,
So-
man, let's do it. So I will pull this all the way down to, how many is that? That's 12. Okay. All right, shoot me.
So we have 1163, 1317, 933, 1317 again, 809, 550, 1163, 1082, and 1082. Bingo.
Thank you.
That's such a bad.
Well,
joke.
that's divided. If it's 9, we'll divide it by the 9, so it's 1046. It's 9. It's 9 occupied, right?
Yes, 9. See, we're even adding cool features every week. This is cool.
That's right. We even added a little debt overview here. All right, and this is 10 units.
So
And
that's
it-
also the point. As we go through this and as you guys play around with the calculator, let us know if there's anything that you're like, oh, I wish this calculator had this, or hey, I have a question about this, and we'll go over those as well on these calls. That's what these calls are for, is to make sure you guys know how to use these tools.
And
Right,
Rennie,
and
this
Ren- yeah, go ahead.
this is a new tool, and so we'll throw this link into the chat so you guys can access this. You can download it to your computer. So this is a different tool than what we had been using previously. So we'll make sure you guys have those links.
Do we know also what class it is?
That's
It's
Jennifer.
it's gonna be like a C.
Okay. Like a C-ish class. Okay. What's the
Yeah.
what's the guidance price on this?
989,
9.
What's that?
989, 989,000. And rehab from the pictures, I think a little more than light, probably.
Yeah. And
Heavy,
some are gonna be, probably need very little to no, and some's gonna need much more. Like that one that's 550. It needs, a full, not a gut, but a full redo.
Well,
Oh.
we have
heavy just in case, because you don't know the roof condition, you don't know the external exterior stuff. Just to be on the safer side, and then if it's too much of a discrepancy, we'll explore that later.
So it
Right.
seems like they put out some expenses on here as well.
Yep.
It'll be good to just kind of look at and add up. I've not added those up, but I can do that on here to see how it compares to our expense ratio here. Your taxes are probably gonna go up just because they're gonna reassess potentially. So is your insurance potentially. This insurance at $4,000 on a 10 unit. I mean, I'm getting like 500-600. I mean, even people talking about underwriting at $1,000 a unit, which is kind of high. So, I mean, this seems to be less than that. Let's see.
And guys, one thing, actually, Aldo brought up something that gave me a point I want to address. We will say continuously, know your market for stuff like that, because in the market, Aldo and Will and I look at actually just my market and Aldo and Will's market, we're gonna have different taxes and insurance and all that stuff. So if you know your market and you know what those common rules of thumbs are, because at the end of the day, if any property you give me in LA, I'll have an idea of what the tax is gonna be. If I give it to anyone else, there's a good chance you're not gonna know because you're not in this market, right? So that's why it's really important to know your market. So these numbers make more sense to you and we can help you better. So we know what those numbers are. We know what the rule of thumb is. Like, oh, this is on the lower side, or I adjust this on the higher side, for example. So keep that in mind when you are looking at a deal, that you want to know the market for small stuff like that.
All right, so let's get to this. So, Jennifer, when you see this and you put in all your information here on this napkin side of it on the left, and you see the going in cap rate at 5.71, what comes to mind? What do you think? Is this a good deal? Does it have legs? Could you, does it have potential? What are your thoughts on this before we start getting further into it?
Well, from what you just said earlier, it depends on what I can get debt for, but debt's going for more than 5.71 right now. So it looks like it's negatively leveraged.
And that is correct. Jerry could probably tell us.
I'm working on a quote on this one here while we're talking.
Okay, let's go.
There you go.
This property, being that it's, I mean, the total asking, like their asking price is below like the limits for agency debt.
Mhm.
So like agency debt, you're in the fives, but for something like this, you'll have a hard time finding a bank lender. Especially right now, the banks are tightening up quite a bit. But there's a lot of private lenders out there, and that's how I'm going to have to run it. And you'll really do good getting 8 or 9% on this one.
Yikes.
Because you're having to go to a private source. Agency debt is government money. It's a government program, and they can afford to they can afford to offer the really low rates and things because they're mission driven.
Mhm.
And so to make sure that your property is going to qualify for agency debt to get the best rates is important. If you don't plan to go in and offer, this property at a 9 cap or something like that,
So that's a good question, Jerry. Let's say they're asking right at $1 million.
Yeah.
What's an agency rate?
Agency rate right now, I mean, the treasury today was at like 5.86 or something. It closed the day or 8.7. That the 10-year was, but the spread is like 3.
Oh,
So
wow.
you're at like a little over a 6% right now today. So the spreads have been getting bigger. Even as the treasury's going down, the spreads are getting bigger, just kind of a sign of the economy being kind of discombobulated. If you wait a couple days, that could change around and we could be back down in the 5s. You never know. But you can't, the agency debt don't pick up until your loan amount's $1 million or more. So,
And it also depends on whether you're using Fannie or Freddie, whether you can lock it in that, as soon as you sign the PSA, right?
Yeah. Freddie or Fannie is a lot better at locking them in than Freddie is. And really, I mean, any of the private lenders, when they say locked in, I kind of take that with a grain of salt, because if things happen in the economy and change things around, you're never really locked in until you go to closing.
Hey, Jerry, there's a good question in the chat. But you just talked about the spread. So, the rate's at like 5.89, but there's a, 30 or,
Well, yeah, the spread is like the difference in what our interest rate is that we would buy something at in comparison to like the rate that they base your rate on. So the agency debt, they base their rate on the 10-year treasury. A lot of your home mortgages, they'll base it on the 5-year treasury, and a lot of the bank loans, like the credit union and stuff, base it on the 5-year treasury. And then the spread is like the difference between the 10-year treasury or the 5-year treasury, and then what you're actually getting as far as your rate for your loan. So
Can I jump in real quick too, a quick question, or just to clarify? You mentioned the $1 million number, correct?
I'm sorry.
You mentioned the $1 million threshold, right? That number.
Yeah.
I don't want anyone to get the idea of I'm gonna go offer on this property that they're asking $989 and just offer 10,000 more and I'm okay. It's the loan number. Please make sure that's clear, because you can have, so you don't go all of a sudden like, oh, I'm looking at properties only over $1 million. It's the loan amount, not the purchase price. That's very important to distinguish the two different things. Because I don't want anyone going to Jerry like, hey, I found $1 million property, help me. And it's like, yeah, but you're putting 50% down. I can't. Or even 10% down. I can't. So keep that in mind as well, guys.
Yeah.
Awesome. Thanks, man.
Yeah.
So I did talk to the realtor and she said that he is interested in seller finance, but you'd need about a half down. So it'd still be having to get a pretty big loan.
Jennifer, did you ask what the terms would be? Did you talk about terms at all? Like
She
besides the
just said,
down payment?
she just said it'd be best offer. So I didn't get into that with her.
Got it.
So something we've done is we've been asked what terms we want, and we just say, well, if you ask me what I want 0. That's what I want.
Right.
What could work? Or, I want 2%. Is that going to work for your seller? And kind of go from there. We've been kind of barked at before, but I mean, they ask us what we want. So yeah, I would, encourage you to kind of ask and see what it is that they need to get out of this property so you can make a better educated offer if you need to. At this point, the pricing either has to be much lower or you have to be able to get seller finance below that, preferably 4 or less percent. If it were me underwriting this, by the way, some people have different risk thresholds. And so if it were me underwriting this, I would want something at 4 or below.
Aldo just said something as well that's very important. He said if he's underwriting it. When you're ever underwriting a property, know your buyer. If you're your buyer, if you're buying it yourself, like I'm taking this down with my team, with my resources, whatever the case is, cool. From day one, like right now, write down what is my criteria? What am I looking for? What it makes a deal. As ridiculous as that may sound, it's really hard sometimes to know what a deal is if you don't know what you're looking for. I might look for something different. I'm looking in LA. My buy box is not the same as Aldo's and Will's, just because it can't be. If I'm relying on cash flow, I'm never going to hit it. If I'm relying on appreciation, that's a different story.
Mhm.
There's some people who don't even care if it cash flows or appreciates. They want the depreciation. It's the exact opposite. So I don't mean to confuse you guys with all these different ways you can underwrite, but really pay attention to what am I looking for? What is my buy box? What is the person I want to work with buy box and so when I find a deal, I can get in front of them. And why do we say share in the chat what you're looking for? So when someone does find something, they remember you. If you just say I'm open to anything, no one's going to send you anything. That's just the reality of it. Or you're going to get a lot of stuff you don't care about. Go ahead, Jerry.
Yeah. Yeah. What state is the property located in? I didn't catch that part.
Montana.
Montana.
It took me a while. I'm like, MT, what's MT? I'm really bad with geography, so just ignore me.
I told him within 2 seconds it was Montana, and Ed didn't believe me. I was like, dude, MT is Montana. It's like,
No,
just
I'm
trust
trying
me.
to find it on a map. That was my problem.
Yeah, it's in my town where I live, so I could literally drive
Love
by
it.
and look at
Okay.
And
What's
that's
the
huge.
What's the population like there? Just
It's 34,000, so it's small. But it's got a college and we're actually where the series 1923 was filmed. So that's a Yellowstone spinoff. So there's a lot of people coming here because Bozeman is blowing up and they're an hour away. So
gotcha. Yeah, that's kind of another thing to throw kind of the deal off as far as getting really good debt is if it's more of a rural area or the population isn't real big, a lot of times that'll hurt being able to find funding. In those situations, I mean, a local credit union, things like that is your best friend.
Mhm.
But as far as like a lot of the big lenders that lend nationwide and things, those get a lot tougher when you're in the secondary or markets, or even, I mean, this would be a smaller than a secondary market, but that just something else to kind of throw a wrench in things when you're looking at debt and you see this. How long is the debt good for? Like the assumable debt on here? How long
it's
is that?
seller finance. There's not an assumable. It's not assumable. That wasn't filled out correctly.
Oh, okay.
Yeah, it is not, she's pretty sure it's not assumable. She's gonna check, but she's quite sure. It's about 7 years that he's had the loan. And I don't know how much he owes still.
Can I make a quick point real quick? And this is why we try to provide as many of the resources as we can. For example, Jerry, and like, I'm so happy you're on this call. This worked out so perfectly, because there's a lot of stuff that I wouldn't be able to tell you confidently. But also think about it like this. You are not getting any information differently, or it's not going to be different for anyone else. No one else, other buyers going to walk in, wave a magic wand, and get the debt that Jerry was just referring to. They're going to be told the same thing. You just got that information faster and more accurately, correct? So then you use that as a resource, like, hey, knowing XYZ and what can and can't be done on this property, there's one of two ways. You lower the price, or the seller carry terms favor me. And that's how you're going to be able to find a deal. Because one thing that you have to make clear to brokers, and especially starting out, it's easy to get lost in this and lose time. I don't want to say waste time, but you'll lose time. Is just because a property may be a good buy doesn't make it a good deal. If you're going to do 3 of these a year, you want it to be a good deal. And you don't want one that you're doing, or like you're in escrow or about to close escrow, something better comes on the table and you're like, I wish I did that instead. You don't want buyer's remorse. We call it a deal, not just, hey, I bought a property, right? So those are important things to factor in, and use this knowledge as leverage to, like, hey, broker, this is what every buyer is going to have, this issue of the amount of the loan or population. Knowing this, you have a leg up and you can offer and put your best foot forward.
So there
Okay.
is a question. Sorry, go ahead. Finish up.
I just said,
Is it just me, or did we lose her?
I think we lost her.
No,
Yeah.
she's there.
Oh,
Sorry,
okay.
go ahead, Jennifer.
Go ahead, Jennifer.
I just said thank you.
Oh,
So-
Yeah, you're welcome. So, so Linda had a question: is assumable debt desirable to most multifamily investors? And I think the key answer is almost always, it depends. Right? And like it totally depends on what your goals are, what your risk tolerance is, what the market's doing to, and so, for example, yes, it is desirable at surface level for sure. When it comes, let's say this deal, you have it at 571 and there's assumable debt coming in at 4 or less, and especially if it still has an IO term, which means interest only term on it, and it's got a few years left, like 5 or more left, great, because then you can dispose of it, and you can minimize your penalties the farther along it goes, as you sell it. So, but one thing to understand as well is that, let's say your going in cap rate is 5.1, right? And you buy it at 5.1, it has great debt. When you go to sell it in this environment, it is likely that either the market is going to expand, which means that the cap rate is going to expand or grow. It's going to go up from what, let's say it's 6.5 right now. It's going to go up from 6.5, or it's going to come down, but not all the way down to 5.71, or it's just going to stay stagnant, which means that you bought at a lower cap rate, which means you bought it more expensively. And when you go to sell it, the value that you get from this deal is going to be less because you're using a higher cap rate, if that makes sense.
One thing I want to point out that Aldo said, and why it really does depend, is what are the terms of the debt? Is it variable or fixed? Which is very important, because someone can advertise, oh, well, come get this 3.5% loan. They're like, oh, by the way, the maximum of the variable is 9. And you're just like, whoa, what just happened? Like, this great debt turned into the worst part of the deal, the structure, right? Also, another important thing is, what's the term of it? How long is what percentage of the purchase price is the loan as well? Like, if it's easy numbers, if it's $1 million purchase price, the loan is 500,000, you're coming down 50%. And that's why I always ask, are they willing to carry a portion of the difference? So is every assumable debt good? No. Is most of it good? Yeah, it should be. hopefully. And trust me when I say this, if the assumable debt is attractive, a good a decent broker will advertise the heck out of it. Just bottom line, like that's something in this market that you want to make sure everyone knows about. If there is an assumable loan and they're not really marketing it, either they don't know what they're doing or the debt's not attractive. So it's always good to ask, don't get me wrong, because sometimes they don't tell you for whatever reason. But yes, ask. It does help, but also know what to look for and what to do with it. Maybe one of these calls we will go over like what to look for on an assumable loan, because that's a topic in itself. So again, answers it depends, which is a lot of things in real estate, but those are just the key things to look out for.
Jennifer, would you be managing this property yourself?
Good question.
I would probably get a property manager. Yeah.
Okay.
No.
Do you know if they
Okay.
have currently? Is it on the expenses?
It's probably gonna shoot up your expense ratio. So that you probably won't get one for less than 6 to 8%.
Do you know if I didn't see it on the expense ratio, but do they have a property management company currently?
They don't have a property manager currently because he didn't like how they were doing it. So,
Got it.
yeah.
Okay. So
With,
before we run out of time, Andrea,
Go ahead, Andrea.
Hear me?
Yes, ma'am.
yeah, we can hear you.
Awesome. Sorry, I was driving earlier, but I just want to re-review. How did you guys arrive at that total income? I know there's probably multiple spreadsheets you have open, but did you, for the total income of this example that you just ran through,
Mhm.
where did you pull that?
Yeah, so we took all of the rents and we just got a weighted average of the rent. And then we went ahead and we put in the total units as 10 and then 90% of that. Because our average rent right now is 1046. There are 10 units and it's 90% occupied because it's 9 out of 10. It's 9 occupied, so it's 90% occupied. And so we just multiply that all the way out for a whole
We're
year.
assuming a 50% expense ratio as well.
Are you
And
talking about
so-
the top line revenue or are you talking
Yeah.
about the NOI?
Okay. No, just the overall total income, because this is actually a really good quick underwriting tool. You guys came up with a really good one. Did you guys draft this?
Yes,
Yep.
we made.
We made it in
Love
about
it.
like 10 minutes. No, I'm kidding. I might not be kidding. I don't remember.
Yeah. No, this is great. I mean, it's funny because I was just looking at, other quick underwriting templates, Michael Blanc's and whoever's, and you don't really get the full scope unless you look at the actual rent roll to see what the income would be if you total out the average rent from what you're getting if it was 100% occupied. But this is what you're pulling, right? Average
Yes.
1046.
It's pulling from this little convenient mini rent roll, average gatherer. And then there's also an exit napkin underwriting on here that you could figure out, the potential upside based on your pricing. And we're sharing it right now, the tool, so you
Yeah.
want to check it out, feel
And
free.
one
Yeah.
more thing I want to add as well to that income line. When you're looking at an OM, if it doesn't add up 100% equal with the income, remember they may be adding additional income. That's something to keep in mind. They can
Right.
have rent, pet fees, late fees, X, Y, Z fee, whatever it is, and all of these things. So that's why your total income will look different. So keep that in mind as well.
Right. I'm wondering if you guys have any rules of thumb for cash flow, because like one of my teammates, he just came back from the Grant Cardone event and he said that his, if we're not cash flowing 2,000 a month, at least 24,000 a year, he doesn't consider it a deal. Or, but he invests in A class. I mean, do you guys have like standards for how much you should cash flow for your deals?
No, I love that
It's
question.
gonna vary between Ed and us, probably.
That's exactly what I was gonna say is,
Yeah.
what type of buyer are you? What are you looking for? Are you looking to partner with someone? Are you looking to buy and manage and hold yourself for example, I can speak this confidently. I know someone who holds a mastermind, 5,000 plus units they've operated and turned over. They have a rule of thumb where after paying your pref to your investors, they want to cash flow $100 per unit per month. Doesn't matter if it's 5 units, doesn't matter if it's 500 units. $100 a month. No questions asked. After all expenses, paying off all your investors, that's what they want. How they split that after the fact doesn't matter. That's just the easy number. You can never get it wrong, right? I obviously can't do that. Well, I can. It's just not as fun because I'm going to be underwriting a lot of bad deals in LA. So I have a different requirement. But when I'm looking in, for example, Texas, which I also do look at, and in Georgia, I go based off of the cash on cash, which is a different, has to do with the cash flow, but you can't look at the cash flow and determine that because it comes down to what are the terms of the deal. You'll hear me say that a lot, but that's my kind of thing where I'm more, I care more about how the deal is structured than what the price is and what the numbers are, because I can't change the rents of, or the pro forma market rents of an area, but I can change the terms I get on a property, on a deal. That just comes down to my negotiation. I hope that helped.
And so,
Helps a lot.
and so for us, Andrea, the way we look at it is investor first, just because, you know, we're syndicators. And so we look after this, you know, at the split, our investor is going to get at least 8, maybe 9% return, cash on cash return on their investment, average annualized, right? And so we want to provide them that, and we also want to provide them with a good IRR, you know, so that they can have a choice on what to invest on. So, you know, everybody's different. And like you said, somebody wants $2,000 a month. That's great. I'd love $2,000 a month on a property, but that's kind of what we look.
Okay. And just my last question with this, it might be just way down the line, but you know, I've been considering an investor portal recently, and I've heard one called Cash Flow Portal. Do you guys have a CRM or investor portal that you currently work with that could also help with like waterfall distribution calculations, or do you just do the waterfall and you guys manage this all in-house?
Listen, we don't get as complicated into the waterfalls. We really don't. We just keep it as simple as possible, and we don't have a portal. We just, right now we're keeping it simple within us, and we don't have, you know, thousands of units to manage. We will at some point. So we just keep it all in house and manage it ourselves. And no complicated waterfall syndications for us right now.
That's definitely a scale like in terms of like where you're at in the business type of thing, because there is like costs and investments that come with that you want to make sure that and it's tried and tested, and I think that's the biggest thing. So starting off, I wouldn't recommend anyone worrying about that stuff, but if you are into it and you do have want more questions and insight on that, we can talk about that offline probably.
Cool. Thank you guys.
Thank you, Andrea. And we're right at the hour, but we couldn't let this go without letting Jerry get on the mic one more time.
Hey, sorry guys if I'm being a mic hog here, but yeah, you were talking before about the cap rates and you know, buying at the lower cap rates. That's what's happened to people over the last you know, couple years, and now cap rates are rising and they're losing all their equity, you know. So guys, you know, and if you look like a few years previous, they were buying at higher cap rates, and then the cap rates were going down, and that's how they gained all the equity that you see all these people that made, you know. So just realize that when you're buying and taking assumable debt on, don't overpay for the property, you know. So and then I saw somebody ask the question about CapEx work on the agency debt. When you're looking at the small balance agency debt, like under 7 million, 7.5 million, it, you know, rehab work is something you really shouldn't figure on through agency. When you're looking at the bigger stuff, you know, 7.5 million on up, then we can start looking at some of the rehab money involved in a loan. But agency debt isn't for rehab generally. It's like, you know, you need to do a bridge if you have heavy rehab, or raise the money generally. It just gets to be too many moving parts, especially on the smaller loan balances, like 7.5 million and below. So hopefully that answers your question, Natasha. So
Thank you, Jerry. Appreciate you
Yeah.
answering that, man.
yeah,
And
no
Jennifer,
problem.
thank you for bringing this deal. You know, I think this deal has some definite potential. You know, if you can get it for the right price, and if you can get the right lending terms, especially on the seller finance deal. So yeah, reach out to Ed or Aldo, myself. We'd love to, you know, chat offline on this one and help you out, and, you know, maybe give you some other questions to ask the broker that would be really helpful for you as you go back and negotiate this deal.
Thank you.
Yeah, awesome.
Awesome.
Thank you, guys.
Thank you, guys. Be sure to visit the rest of our ecosystem. Tomorrow night, I think we have the one and only Victor N to the G talking about advanced underwriting. I highly recommend it. This is underwriting 101. His is underwriting 501. So if you wanna make your head hurt for a little bit, go ahead and hop on and learn a little bit more about underwriting. So with that, we're if you guys don't have anything else, we'll go ahead and leave you guys with some energy.